Welcome back, everybody. It is Tuesday night, the Tuesday before Thanksgiving. So we are thankful that you are all here, thankful that we get to show up every week with a new topic, with a new group of vetted pros to go through a topic of interest to you, to answer some questions that we regularly see in the Vetted VA group in Facebook. For those of you that are watching live, who are here, if you have questions, primary purpose of the show is just to be here live, to be able to answer questions a little bit more in depth and a little bit more detail than what we can just in the written format in the Facebook group. So with that, tonight we are going to be covering in detail the loan estimate, answering everything that you need to know about your loan estimate and how you can use that as a tool to compare the offers from different lenders without getting taken advantage of, without having it used to kind of confuse you and distort what's going on there. So with that, I got two great pros from different parts of the country. We got Thomas Sloan from the top right of the country in New Jersey, and we got Randy Tickle down in Salina, Texas. Randy, I forgot to tell you last week, my wife was traveling in Texas, and she went to a dinner at some people's house that there was a business dinner, and she says, we're in like Salina, Texas. And I go, it's not Salina, it's Salina. I got a friend there.
Right. That's how you know who is really local, is how they sell, Salina versus Salina or whatever.
Absolutely. So with that, why don't we jump in? We don't normally do slides, but with tonight's topic, it is one that definitely beneficial to have that. So again, going through the loan estimate and how to compare lenders. So with that, Randy, why don't you start us off? Loan estimate is a 3-page document. Maybe just tell us what in the heck it is. What is a loan estimate? Is that my good faith estimate? What is a good faith estimate? When do I get that? And just kind of give people a little bit of the background and some of the questions they should be asking and when they maybe should expect to get this document.
So basically, just a little bit of history to begin with is we didn't always have a loan estimate, closing disclosure, etc., differentiation between the two. But the government's gotten involved a couple of times, and every time the government gets involved, it's to simplify things, right?
Much simpler.
And so I would tell you that when this whole thing came in place with the TRID and the 3 days of disclosure in advance, etc., it was a little bit confusing for everybody involved. But basically, the in theory, at least, what this estimate is supposed to do is to standardize everything so that the shopping is easier, where that you're looking at the same form for everybody on the loan closing, and you're supposed to be able to have it in advance. Obviously, you're supposed to have it at the disclosure point, a loan estimate. Typically, those loan estimates are not going to be necessarily the same as the final, but they give you a jumping off point, and so that you can look at different things. And then we'll go through it as we go, but obviously they're going to educate you on aspects of your loan that are important to you, and they start with the most important thing, which is your loan amount, your interest rate, your principal and interest amount, and then your escrow, whether or not there's a balloon payment, and whether it's a fixed interest rate for the life of the loan, etc. That's all on that first page for us. Basically, it's just a way for you to compare. If you have two different loan estimates from two different lenders, you should be able to look at one box and correspond it to the exact same box on the other form in order to compare and shop.
And in terms of talking about loan estimate versus the good old days, bad old days of the good faith estimate, sort of a misnomer, because there was a lot of bad faith. All of us who were doing loans all that long time ago would come across a situation where you would honestly and accurately complete an estimate for a borrower so they know what their payment's going to be, what their interest rate is going to be, what their total cash to close is going to be. And they would come back 3 days later, well, someone's giving me a 1% interest rate and I'm going to pay nothing at closing and there's no closing costs and everything's perfect. Only to 25 days later, call crying because they had to bring in $25,000 at closing. Their rate was 10% and nothing went the way it was supposed to. And there were no legal repercussions at that time. As long as the lender could say, made a good faith effort. A couple things changed through the process and we weren't aware of it. And this is where you're at. And basically there were a lot of bad actors that counted on you getting very close to the closing table and not having options to back out, change, go to a different lender. So with this, what we'll get to on page 2, the important part, it sets tolerances. No one can know all of the charges from day one, but we should, as professionals, have a really solid idea of what they look like. So here on page 1, Randy, one of the things that I love to point out, really, you're just fact checking. Is my name correct? Is my property correct? Is that really what I'm paying for the property? But that one, the box of text there on the rate lock, this is how you're going to know, do you actually have it locked? Most lenders are going to send out a rate lock agreement. Some will have you sign it ahead of time. Some will send you a confirmation, but you are going to get a locked loan estimate. So as you can see in this example here, it does say, yes, it is locked. It's locked through December 9th, actually until December 23rd. Day of what? Christmas Eve on this in this situation. But that's really, really important, because when we get to page 1, these guys will walk you through that if it's not locked, then the tolerances are not nearly as narrow as they otherwise should be. So continuing here with that first page, Thomas, walk us through what else we start getting broke down for us.
Sure. So the first section is going to break down our payment. That's going to be the principal and interest, which is your mortgage. In this situation is $2,268. Mortgage insurance if it's not a VA loan and you put less than 20% down, or if it's FHA. And then your escrow, which can consist of either taxes or insurance or both, or neither, depending on the lender. The 338 in assessments is going to include 3 potential fees: your taxes, your insurance, and maybe a homeowners association dues. So if you're buying a condo or a townhome or anything that has an association, you won't make that payment in that estimated total monthly payment section towards your HOA plus principal and interest plus taxes and insurance. But it will break it down because it is part of your housing expense. So it's important to know how much that house is costing you each month, because that's your actual housing payment. And then the next section, we have closing costs and cash to close. This gets confused very often, but the simple fact is how much money am I going to bring to closing? That's the cash to close. And then total closing costs are going to be your estimated closing costs. Some of these will be financed. Some of these will be paid before closing. And most of these, in most cases, will be paid at closing. So in this section, you can see the $20,679. That's going to include $17,256 in loan costs plus $34,23 in other costs, 0 in lender credits. And then the second page is going to break down all of the fees that go into this magic.
So there's a couple of interesting things here, and I'll play the role of the consumer. And the question that we get is, looking, it says my escrow is $259, and then it says $338 down here for taxes, insurance, and assessments. It oftentimes throws the consumer off. In this instance, this property is a single family residence. It has a small homeowners association. So the difference between that $338 and the $259 is that difference. And as Thomas said, you don't pay the $338. You're not going to collect it. Oftentimes I get that. I don't know about you guys, but they say, why does my homeowners association, I've never had to pay my HOA dues to the lender. You don't, but we have to disclose it to you because, again, going back pre-TRID, we had people that weren't having everything disclosed to them. They weren't having their property taxes disclosed correctly. They weren't having their HOA. So, again, it's really there to show you what that total monthly payment looks like. But here's the fun one with VA loans. And this situation here is a unique one in that it's a veteran who just went through a divorce. Doesn't have a ton of money, so he's doing 0 down, but there's subsequent use. He's using it again. So how do we get to a situation, Thomas, here where we can have $9,200 to close, but a little over $20,000 in estimated closing costs?
So the VA has a funding fee when you do not have a disability rating. And if you're using it as your second use or your subsequent use, it's going to be 3.15% of the loan amount. So in this case, it's $300 and change. That difference is a little over $9,000, I'd say, right? 9,000 and change, nearly 10. So that's that difference is what you're seeing there, of $20,679 and $9,261.
And it'll make a lot more sense once we get through and start breaking it down on page 2. Page 2, and when I put this slide deck together, I wish I had put the full page, because what we're going to look at, the next 2 slides are basically the left half of page 2 and the right half of page 2. And this will kind of break down and give more color and detail to what we have here. So Randy, why don't you start walking us through that closing cost detail on the left side of page 2, which is really what most people want to know. Cool, I'm getting a loan for $350,000 and that's what my payment is, but what am I paying for it?
Well, for starters, I think we'd be remiss if we didn't at least appeal to all the veterans that are watching to make the first step towards getting that funding fee waived. I would say that it only takes a 10% rating to waive the total funding fee. And in this case, like we talked about, $11,418, 10% rating takes that away. And so what I would tell you is that I do a webinar in person and on the web every month with the local American Legion, and we help educate people on how to get started on their claim process. And it is really, really simple. And the biggest easy button is to understand that if you've been in the military at any level, any place, whatever, you've probably been exposed to loud noises, whether it be on the firing range or the flight deck or machines, et cetera. And I would tell you that you probably have tinnitus or tinnitus, depending on how you want to say it. And that's a 10% rating. So there's my commercial for you. Start it today. Tell your loan officer that you started the process. Like it's as simple here locally for me as sending you to the local VA hospital and walking in and saying, hey, how do I get started on my rating? And I would tell you, only do the tinnitus first. You might have 5 other ailments, but if our purpose is to get you in a position to waive the funding fee, take the one at a time. Get it so that you're clear to go do your loan without a $11,400 charge, and then go back and add the rest, because that might take years. And if you start with all of them at once, they all have to be judged, if you will, which could take a long time. But the tinnitus is very easy, very quick, and you're going to be in a position to help yourself save $11,418 and whatever it was the first time. So realistically, had this veteran done it the first time, he would save himself or herself. Would have saved themselves somewhere around $16,000-$17,000 by taking that impetus to go and get that claim started. So sorry for my commercial there, but that's something that's huge for folks.
No, it's a good one. We had a little bit of a little mini refi boom here in the fall, and some people, when they were looking at it and have a 0.50 funding fee on the IRL and they have to pay for it, look at it and go, it's not worth it. The people that didn't have that, it almost always is worth it. You can do a no cost, not have to finance an additional 0.5%. So it can make the difference between doing something, not doing something. It can make the difference between, in this situation, probably needing to be in the home for a good 5, 6, 7 years versus possibly being able to move faster or accrue equity faster. So definitely love and appreciate that advice. So again, we're starting here on page 2, and page 2 of the loan estimate is where it breaks down everything. So I'll give a little spiel here ahead of time. When we look back here on page 1, where it says estimated closing costs, I don't like, so Randy made the joke early in the show about the government getting involved in simplifying things. This is one of the situations where the loan estimate, closing disclosure, setup scenario that we have is 1,000 times better than what came before it. Better for the consumer, better for us, holds us as mortgage professionals to tolerances where you can't screw things up and you have to do things in a timeline or there's real consequences to it. But with that, one of the things I don't like here is this estimated closing cost. Well, that includes $17,256 in loan costs and then $3,423 in other costs. So as we go forward to the next 2 slides, this is the left side of the loan estimate, of page 2 of the loan estimate, and this is loan costs. So when you look there, that's loan costs and then other costs, and then we're also going to break down here what are those other costs, and then the total cash to close. So important to remember that the left side are the actual closing costs. That's what the loan is going to cost you. For the most part, the things in the other costs over here, those are recurring costs of home ownership that are going to come back and recur over your lifetime of home ownership. So for the most part, when we're comparing what a loan costs, you're going to be looking at that left side. So Randy, we both gave big, long, rambling commercials there. But with that, why don't you jump in and start walking us through what are these boxes A, B, and C that comprise loan costs?
Well, for my money, box A is the most important by far that you understand as a borrower, and it enables you to compare apples to apples when you're shopping. Because box A, people, even though it all has to be in this A, there are different names for different things that different lenders charge. But anything that really has to do with origination has to be in this box A. So it could be, obviously you've got admin fee, doc prep fee, processing fees, underwriting fees. There's also discount fees to buy the rate down. And then there's origination fees, and they all go under this box A. And so when you look at it and you're looking at apples to apples, let's say the rate's the same, the payment's the same, but the cash to close isn't. When you look at this box right here, comparing two different lenders, this is the most important thing that you compare. Because for the most part, the rest of these things, the B and C, are going to be decisions that other people are making for you. Whether it be your realtor picking the title company is going to be the same no matter which lender you use. The or the different folks that are lined up to begin with. Now you can switch title companies, but I don't know that happens very often in my world because usually it's all decisions by the two agents, and so it doesn't matter which title company. They're all going to be this. They're going to change. It's going to be the same. And so the fees are going to be the same for the most part. But box A is the one that can vary a lot from lender to lender. And sometimes box A in coordination with, I forget what the one is where the credits show up. What's the letter
J.
on that? J?
Yeah, right
J.
there at box J.
J. So A and J together basically are going to tell you everything you need to know to compare. And that's my wisdom is if you could only look at one thing on that estimate besides the payment, that would be the one that you would need to dial in.
Well, I always like to jump in at that point. We get questions from borrowers. Well, what's your APR? What's your APR? I always like to ask, do you know what APR is? What's my rate? No, it is absolutely 100% not your rate. It's a synthetic number made up by the government that was supposed to make it where you could compare loans, but it only works if it's fixed to fixed, same loan term. When you start throwing variables in there, it is almost a worthless number. That doesn't mean that comparing is worthless. But when we talk about fees, so what Randy was saying is box B and C, that's generally on your purchase going to be dictated by the terms of the contract. So you can go to Randy, you can go to Thomas, you can go to Brandon, you can come to me. And the only thing that's going to vary is box A, because everything else is dictated by the type of loan, the location that you're at, and what you agreed to in your contract. So really, when I say VA loans, we say 98% of them in the current day are going to be a 30-year fixed. There's some 15 years. There may be a few ARMs done. But if we're comparing, what's my interest rate and what are my box A charges? So Randy listed all of the things that could be there. I always like to say, it doesn't matter what's there. And probably the craziest thing I've ever seen in box A, you guys will get a chuckle out of this. Someone sent over a loan estimate to compare from another lender, and they had a line item in there that said Encompass technology fee, $100. And you're like, what are we talking about? That's the software that many loan officers, many lenders use to process your loan. And these guys decided that you should pay $100 a month. It is a very expensive software, absurdly expensive, but they decided that you should pay for it. So at the end of the day, you could look at it and go, well, that's insane. And you should never work with that lender because they're charging you for their software. But what if they had a rate 0.5% lower than anyone else? Or box A was still lower than anyone else's at the same note rate? So I don't know about you guys, but I tell people, don't get hung up either way. Just say, what is the interest rate and what am I paying for it? You can add everything. If you guys look here where it says box A origination charges, that in the gray bar, that's a total. So I don't get hung up on what those things are. If it's zero, then that's truly zero origination fees for that interest rate. In this situation, this is essentially a half of a point total fees there for that interest rate. And if you go to someone else and they go, yeah, I can get you that interest rate, but they've got $2,500 of fees, that's more expensive. You go to another one, they say, we got nothing in box A and we have the same interest rate. Now you have a point of comparison. Brandon, you hopped in late, so I'm gonna throw it at you. I'm gonna put you on the spot here as we roll through this. So box A really is the primary box there for comparison, but that doesn't mean that we don't need to be accurate in the other boxes and borrowers don't need to know what they are. But box B is interesting, and it says services you cannot shop for. So what are those? Why can't the borrower shop for them? And what does that mean in terms of tolerances of what this could possibly change between this loan estimate and when they get to closing in their closing disclosure? I think we've got you on mute, Brandon, or we don't have your mic.
All right. How's that?
There we go. Now we can hear you.
I was just making a joke about technology. Like I just was saying that like I shouldn't be charging anybody a technology fee when I come to the office for the first time in 3 months. I can't get the laptop work, and then I couldn't even have the microphone work to boot. Right when I was making the joke. So,
maybe you'll have a microphone fee so that you can get a fancy studio mic.
Or I could try to charge like a desk fee, because that's probably like the equivalent of like the Encompass fee that just anyway.
Walk the dog fee, because so many people work from home now and the dog has got to go outside. So
that's right. I mean, it's walk the dog fee. That's the 2025 fee that's coming. But anyway, back to the question, which was, line item B there, these fees, do we want to get into tolerance cures? Well, the thing is what gets disclosed on a loan estimate is, these fees that are tolerance cures, they can't go up more than 10%, but things should be as accurate as possible. And I mean, we all try to over disclose without, blowing the loan estimate out. But these fees are typically out of our control, especially as a broker. Now, if you compare to, a different part of the industry, they can set all those fees like in box A, and that's where you're going to see a lot of those. But like the appraisal fee, depending on the state, the VA has specific amount of fee that gets charged for the appraisal fee that can be looked up on the VA website. And I'm sure everybody right here probably already has that like saved, because different states and even certain different counties or the different type of property, it lists exactly what that fee should be. And yes, VA appraisers can charge a trip fee. That's something new in the last couple of years, because they wanted to entice VA appraisers in areas that are, spread out where they didn't have a lot of certified VA appraisers, to encourage more people so VA appraisals weren't taking too long. But rarely, at least in my experience in the Midwest states, rarely do I ever see that, unless it's a unique property with lots of acreage and a larger home. But credit reporting fee, it's a third party fee. And so they usually gets passed on to the consumer, to the veteran here, where, but we can't charge more than what we get charged. So we have to provide an invoice to the title company to balance that, and closing department for the lender. So that way it's to the penny. My favorite part of that was years ago getting audited and having to send $3 checks to all my clients, because we had overcharged by $3 on accident, and nothing like doing that. But anyway, flood certification, that's going to vary within a couple of dollars. And same thing with the tax service fee. Many lenders, especially in the broker world, in the wholesale world, many lenders don't charge that on VA loans. They do on the other programs, and they do have the cost. They just don't pass that to the veteran. But if they do, those two fees, flood cert, tax service fee, are usually within a couple of dollars of what you see right here. Not much difference. VA funding fee is set depending on if you have to pay one, obviously. If you have a down payment, 5%, 10%, first use or subsequent use, that's all set. So that's not determined by the lender. So it's useless in comparing between, one or more, two or more lenders. Verification of employment fee, again, that's a third party fee. And so you're seeing kind of a pattern here. And it's the third party fee. Appraisal fee is a third party fee. So all these third party fees that will get passed on, and that's usually the cost of that your employer charges. So if they use the work number, or if they use a third party source, so when people have to verify your employment to prove you're still working there, like you said you did on the application, and we verify with pay stubs, assuming it's not an LES or just service connected disability. But if you have a W-2 job, they got to verify that you're still working there, that you didn't quit or get fired. And so if they do that and your employer uses a third party, then that's a third party fee that would typically get passed on to you as the consumer.
A couple of things that I like to note there. Some lenders, so if you're going to a direct lender, some direct lenders, some companies that we work with on the broker side, that tax service and the flood cert, sometimes they roll it in the admin fee. So you may see an admin fee in box A. That admin fee can get bought out. We won't go into the details of what that means, but meaning that you're paying it through the interest rate. So you may not see all of these items here. That verification of employment fee, I don't know about you guys, but 5 years ago, we would never disclose that. But now, I don't know about you, but if we need verification on a third of our files, more and more of these folks are going with the work number. Their companies are using the work number, and you have to go and pay for it. It used to be we would just send out, fax over a verification of employment or shoot over an email, and you get that back in a couple of days, and there's no cost other than our time, effort, and energy. But now more and more we're needing to pay for those. That in addition to credit reports. Before COVID, those work number verifications were $20. So most people didn't care. You eat $20 here and there, not a big deal. Now they can be $70, $80, $120, depending on what all you're verifying. And same thing with credit reports. When credit reports were $30, a lot of lenders would just say, hey, it's a cost of doing business. We'll eat it. Now that they're up into the $80, $90, $100 range, you're more likely to see that. Thomas, why don't you walk us through section C there, where we start getting to items. And again, just the title of it can be misleading to folks. If you're watching at home, it says services you can shop for. I literally had a set of borrowers 2 weeks ago. They were in process with another lender. They hated it. They called me and said, we can fix this. Let's get it. And 2 days after that, so they're like 10 days into a purchase, they said, okay, so on this loan estimate, I see I can shop for these. So I'm going to make some calls tomorrow and see what we can do. So Thomas, walk us through what that actually means in terms of your ability to shop for them and what it means in terms of tolerances.
I would say that every state is very, very different. I'm in multiple states, and from one to the next, you're going to have a lot of people involved in the process. And 9.9 times out of 10, like Randy said, you're going to have the agent kind of select that title company and talk about it with you, along with 1 million other things, right? So it's probably a piece of information that you're not going to hold on to. So while it is a service that you can shop for 99.9% of the time, that is going to be something that is chosen by a trusted partner, right? So your realtor, your attorney, if you're in an attorney state, they're going to have relationships with these companies that provide these services. I think one of the most important things to know about title is that it's federally regulated in terms of what their fees are, but there are differences from one title company to the next. So the title insurance that you see there, that is federally regulated, but there is an enhanced coverage and there's a standard coverage, right? Generally, I think all of us here probably disclose what we see as a standard coverage. Enhanced coverage in this situation would probably be $400 or $500 extra. That's a choice that you have to go with or not. It's something that you should talk to your professional about if that makes sense for you. And then all of the other fees are basically, how I explain it, is just a cost of them doing business, a cost of running their office, a cost of sending a notary to the closing to make sure that the documents are handled and sent and received correctly. These are all just kind of service they can shop for. I think what I would like to point out is on a loan estimate, some lenders have high fees, and maybe in some situations, to offset those fees, they may underdisclose other fees. And they might underdisclose fees that they have no control over, such as Section C. As a lender, we do not have any control. Personally, I like to fluff those fees, but I like to explain that and why I'm doing that. Because at the end of the day, that bottom line, I want it to be lower than it is initially. But it's important to note that I don't control those fees, and here's why. So again, like everybody was saying, focus on that box A and box J, because those are the two places that matter that a lender does have control over based on who they work for or which lender they're going with. All of the other fees are uncontrollables. They're going to be determined by third parties.
So again, what Thomas was saying there with those box C, if we disclose really low fees and we say it's XYZ title company and you end up going with a different title company, there's not a tolerance cure there. We can't be held to that. So there are ways of sort of gaming the system, and you will see that. For you guys, what is your policy or process in this? Speed is important. So from the time that we get a contract and say that the contract giving us a property address is the last of those 6 elements that requires us to get a loan estimate out to a borrower, a lot of lenders, a lot of wholesale lenders that we work with, they offer a smart fees system that will estimate these often to the high side, Thomas, like you were saying, and we can get those out immediately. The other option is to reach out to the settlement provider, escrow, the attorney, get those third-party fees, an accurate quote from them, and then disclose them. For you guys, Randy, how do you do it? Do you generally use like a smart fee system that over-discloses, or do you wait until you have the third-party fees?
We do a smart fee, and I call it a spitball, basically, because it's going to be conservative and overestimate, but get it out quickly. And I just explain that to my borrowers up front that's what we're doing in the interest of time.
In the interest of time, and honestly, on the broker side, some of these places, you can send over the estimate from title, and they still use their smart fees and send them out that way. So in a perfect world, I love to get the third-party fees, and we disclose accurately from that. But sometimes time being of the essence, it's just not an option there. So again, kind of closing the door on this, box A, B, and C get totaled down there in box D. And again, that gives you this number here, or the portion of the number from page 1 of that 17,256. So that's the total closing cost. But remember what we're going to see here on the right side, that VA funding fee in this situation, the high 3.3% is 11,418, but that's going to be financed. So he's not going to be bringing that in closing costs. So, Brandon, you want to maybe walk us through the first couple of boxes here. So, other costs. Again, to my way of thinking, I wish that box E were on the left side of this, because taxes and other government fees, those end up costs of getting this loan and buying this property. They're not going to be recurring things like box F and G are. So it's not quite as simple as just closing costs versus prepaids. But what goes into box E there?
Yeah, so those are definitely costs of getting the loan. I mean, recording fees and other taxes. My experience is that's going to be your recording of the warranty deed on the transfer of the property into your name as a buyer, and the deed of trust. So recording the lien against the property, and that's going to depend on the state, maybe even county, what they charge for your initial page of the recording. And then like in Missouri, then it's additional $3 for every page. So depending on how big the deed of trust is, the warranty deed, that will determine, how much those recording costs are. And so depending on the state, that could vary. But again, that's not necessarily a loan officer thing. That's why it's not important necessarily in comparing lenders, because the cost is going to be really what it is. Now, transfer taxes, depending on the state you're in, some have transfer taxes on both, purchase and refinance. Some don't have it at all, and some just have it on, purchase. So depending on the state, you could see transfer taxes. It's good to ask a loan officer, what's common. If you see it, on your loan estimate, ask about that, and what's common, for that state, because that could change, buying in one state versus another could change the cost by a good bit.
And Thomas, are you licensed in Pennsylvania?
I am.
maybe give an example of what Brandon was talking about. And Brandon, I know you could give an example, but I think this is one of the craziest examples. I had a client who was considering between New Jersey and Pennsylvania, and that kind of came into play for them in terms of property taxes and then also the transfer taxes. I know where they ended up. They ended up in Pennsylvania. I think it was a $600,000 purchase. We had almost $6,000 of transfer taxes that they were responsible for. So I know some states that can be very high. In this here, you see it's zero in Arizona.
And also in Pennsylvania, in cities, it's even higher. I think Philly is like 1.875 on transfer taxes. But yeah, closing costs on a $200,000 loan can be $15,000 to $18,000, which is crazy. And in New Jersey, it's like 9 to 10 or so. Just a big difference there.
It's an important number. And again, if you're straddling states, if you're considering a couple of states, it's something that you want to make sure that your mortgage advisor can walk you through with that. Randy, how about prepaids? What are we looking at? On VA loans, for the most part, we're required. It's not a VA requirement. Most lenders do require them. Some lenders don't. But with prepaids, what are they and what does that amount to? And what should a buyer be prepared to come in with at closing?
First off, for me, I would love to have my folks live in a state that had this kind of insurance. the homeowners insurance here in Texas has gone crazy, and a lot of folks have pulled out, and so a lot of carriers just don't issue. And then homeowners property taxes here in Texas are the Achilles heel. So they're crazy. They would have been the escrow prepaids on this would have been a lot more if we were apples to apples on the purchase price. But basically in the prepaids, on the homeowner's insurance, you basically have to put a policy in place that's prepaid for the year. And so that's what you see in the F portion is the 12 months of it. So you're buying that policy, you're paying for it at close, and so your first year's paid for. The G part of that is that every month you're putting $100 because it's $1,200 for the year. Every month you're putting $100 in to have enough in there that whenever the renewal comes due, there's $1,200 sitting there to pay that renewal. So it starts off because when you close in a month, your first payment's not till a couple of months later. So you've got to seed that escrow account with enough so that you're going to have those 12 payments in there by the renewal date. And so that's where the 3 months come from, because you're closing in December. Your first payment's not going to be until February, because you're closing December, you're skipping January, your first payment's due in February. So you're going to have 3 payments that you're paying at the closing in this section G. And it's the same thing for the, not to the same extent, but the same thing for the property taxes. You've got to seed G with enough where that you're going to have 12 months worth of payments whenever they're due. And that can vary state to state, depending on how it's collected. In Texas, we collect annually, pay out annually in arrears. But I know there's several. I used to be licensed in 30 different states, and I'm not sure which states are which, but now, but some of them, the property taxes are paid semi-annually. Some of them are paid quarterly, and so whatever it's going to take to line you up with that, that's how much you're going to have to do in the prepay portion of G, and then on the back to F, prepaid interest. Same thing that we just talked about. That first payment being due. They make it where that all your payments are going to be due on the first, and in order to right size that, if you're closing on the first, then you're going to have to pay 30 days of interest to right size with the first. If you're closing on the 30th or on a month that has 30 days, then you're going to pay just that 1 day prepaid interest to right size that so that you're due on the first. Does that make sense? Did I say that properly? Explain that?
Yeah, there's a million and one different ways to explain that. I do it a little bit differently, but it's the same. It's the same.
Do
way.
that, please.
Yeah, of course. So in this situation, let's say you're closing December 18th or 20th or something like that, right? So closing in December, your first payment is not going to be till February 1st. Your first payment is going to pay for January's principal and interest, which is in arrears. And because your first payment's only collecting January, you still have the remainder of December left. So that's where that prepaid comes into play. How many days are left in the month? They're going to break down that prepaid per day. In this case, it's 12 days times 6120. And that's how we get to that 734.
Brandon, how do you do that? How do you explain that?
I do that exactly. I mean, and something else I consider is interest credit. So let's say somebody's closing December 5th, especially on VA loans, especially if I anticipate rates being lower in the future. We can never guarantee it, right, guys? But I like doing an interest credit because it said, let's say somebody's closing. I got one coming up on December 6th, actually. That's 26 days of prepaid interest on a $485,000 loan. That's a lot of money, so I would rather upfront be a 4-day interest credit. So instead of paying the prepaid interest, they actually get 4 days of credit starting that amortization on January 1. And the reason for that is that moves up the timetable under VA seasoning to be able to refinance if rates make sense in 2025 versus having to wait an additional month essentially to do that. So, and plus it can come in handy on purchases too when let's say you have a lender that's under disclosed their title fees and you're like, wow, it's an extra $1,500 and maybe you don't have that. Well, maybe the difference is instead of paying prepaid interest, you consider doing an interest credit. And that will vary depending on lenders, how far into the month they will allow it. So you'd have to ask about that. But that is a tool I use to help some people depending on what they need for cash to close or a strategy, for future refinancing potentially. But in terms of explaining, how prepaid interest works, that's exactly it. And like Thomas was saying, it's an amortization schedule. You're doing a 30-year amortization, and it starts that following first. So you pay that interest to bridge the gap. Interest starts on the first, and then your first payment comes due because you're paying interest in arrears per the schedule.
So one thing that you don't really see here on the loan estimate that you will eventually on the closing disclosure, again, sort of an arcane detail here, but lenders are only allowed to have so much in that impound account. So oftentimes this is overestimated. So they have to do a 12-month look forward and make sure that there's not too much in there. So oftentimes you will get a credit and people will go, where did this credit come from? Why am I getting a credit? It's simply to balance out that impound account and make sure that you don't have too much in the account at any point during that first year. The only thing that we really have, well, we got one real important one, but Thomas, why don't you walk us through box H? It's kind of unimportant because for the most part, stuff that falls under there are things that if applicable or don't often come up or should be disclosed or accounted for elsewhere.
Absolutely. But on the tail end of what you were saying there, on the other side of the coin, if you have an escrow shortage, the lender during this, maybe 6, 8, 10, 12 months into the payment of your mortgage, you may get a notice saying that your payment's going to go up. In fact, I just got one. It's the second time this lender has done this to me, this servicer, where they've increased my payment $70 because there's a shortage in my escrow. And because I wasn't paying attention, there's not enough money to pay the taxes and insurance. Maybe there was a miscommunication where the county or whatnot didn't communicate to the lender and the lender didn't pay attention or something like this to where they're collecting based on taxes that are no longer applicable. Or maybe my insurance went up. Again, same kind of thing. So there's two sides of that coin. So credit or additional payment, which could be in a position where maybe I don't, can't make that payment comfortably. So that's just the end of that. Section H, this is an interesting box for me in New Jersey, especially with condos and attorneys. Today, in fact, I was balancing a closing disclosure, and that box H had over $5,000 in fees in it. $5,000.
So, and you say fees, so it wasn't one $5,000 fee. It was multiple items showing up there in box H.
So title sends you a CD and they have there must have been 9 different fees in there. It was an attorney fee, which was standard and it was really high, in my opinion, $1,850. Then they had a $75 reimbursement fee for the attorney. and then they had another $400 admin fee for the attorney. So they're paying over $3,000 in fees just for the attorney, which is like double what it should be, in my opinion. Then there were condo fees. So when you buy a condo, there's a bunch of fees. You have to basically buy in for your membership. They want to collect a couple months worth of dues. For this situation, it was like the balance. It was like $2,000 in fees that they were collecting. Plus there was title insurance, owner's title policy, and some other fee. Survey. I think there was a survey on a condo. There was a survey for $375, which again makes no sense, but you got to watch out. Box H can pile up really, really fast. And that is not a zero tolerance box. You can just add stuff in there and it doesn't really matter. So it's important to understand what type of transaction you're doing and what type of fees might apply in that box. And personally, when I'm doing a condo, I try to overestimate in there and explain to them, like, I just don't know what the association is going to charge, because these fees are not like disclosed to us in the beginning 9 times out of 10. But I always disclose like $1,500 to $2,000 in fees, just to kind of give us a buffer. And if they're lower, great. At the end of the day, you're only going to pay the fees that are due. You're not going to pay additional fees. You can't. There needs to be an invoice for everything that's being collected at closing for the purchase of the transaction.
And that's sort of the purpose. Hopefully you're working with a lender. And I think part of tonight's topic is not just understanding the loan estimate, but how to use it to compare. If you get 2 loan estimates and you're looking at one, this one's $5,000 less, could very well be that in this situation, Thomas disclosed potential $4,000 or $5,000 of Box H items, and the other lender said, well, I'm not going to disclose those because it's not something that I'm held responsible for. And at the end, they'll figure out where to come up with $5,000. So it's an important one. Brandon, you were talking sort of strategically about when to close in terms of getting in with the amount of cash that a buyer has available, a borrower has available. Walk us through Box J, what all that totals up to, and what lender credits are and how they can potentially come into play here.
Ooh, I love this part. J is that total closing cost, which I hate that term because it's completely inaccurate. It's not total closing cost, because that's what people think, like, why are my closing cost $20,000 or whatever? I'm like, well, it's not really all closing costs. So you can call it the old accountant in me about being black and white. I just hate the terminology, but it's the total of closing costs and prepaid. So the cost of getting a loan, cost of owning the home. So that's the total of that D plus I. Now, as Randy mentioned earlier, you got to find lender credits too, because when you're comparing again with lenders, all of the stuff's important to understand, and the strategies and things you may see, like under disclosing or what something may be. But Box A and lender credits and your rate. So rate compared to the, Box A origination fees and lender credits, and what that nets out to be. And then you can compare. I like to do it for myself, like comparing rates with myself. Like, hey, do you like this rate or this rate? And it's oftentimes, this is a strategy a lot of people don't talk about, is, what if you take a higher rate? And people are like, why would I want to take a higher rate? Right? Because one rate may cost a little bit of money versus another rate that's a little bit higher would come with a large lender credit. And let's say the difference is $100. Well, then if you take the lower rate, you may lose, say, $3,000 in credit, or the difference between the charge and credit is $3,000. You do the math on that, that's what I call a 30-month break-even point. So you lose $3,000 just so you can save $100. And in terms of a strategy, I'd rather have the higher rate. Now, again, you're kind of gambling, like you should be able to refinance in the near term. I think we all hope for that and think that. But if you think that, then you don't want people overpaying for a lower rate if you think you're going to be able to get that lower rate or better in the future. Again, can't guarantee it, but I think it's a strategy worth discussing and looking at, what is a higher rate with the lender credit. So I think a lot of loan officers get caught in this trap of feeling like, I got to compete, especially if, in areas where it's very competitive. there's people giving loans away for free sometimes that have zero skill at VA loans and can totally destroy the process and fumble the ball. But so I think, again, people get in a pattern here and they think, well, I've got to compete right out of the gate, and they got to try to offer that low rate with cost as a buyer, or even if somebody looking to refinance. My suggestion would be ask for multiple rates. Don't just ask, hey, what's your rate? Or ask for multiple rates. And if you don't see an option with the lender credit, I would ask for some options with lender credits, especially in the refinance part. Right now rates aren't as low as we'd hope. And so one way you try to get creative is if we could somehow find a way to pay these costs. So there's no net cost. And then what's that savings? So that way your break-even point is day one and saving money right out of the gate. But certainly on a purchase too, if you get in a transaction where the loan officer says, here, let's do this rate, charging this, and you're like, maybe you don't have an extra $2,000. Well, one play you have, and they may not be thinking about or just not offering it, is maybe raise the rate a little bit, where the difference in cost for that lower rate, take a higher rate where the difference is that $2,000 or whatever it may be. And even if you have the money, maybe you'd rather have that money for new furniture, whatever. But ask about it. I would certainly explore an option with lender credit and see what the differences are.
It's funny. I had a conversation with somebody just recently where they were coming to me from a bank, and they basically said, you don't qualify for that rate anymore because we can only use a certain amount of income, which ended up being completely not true. But they forced them into a rate that was costing them $2,400, and it was not. They didn't have it, right. They were moving from I want to say Tennessee to West Virginia, and they had just moved to Tennessee like a year ago and sold their house. So there was no money that they were making on the house, but they had to get back, and cash to close was a big issue. So we started off talking about what it is that was the pain point for them. And we talked about exactly what you said, Brandon, is what does that higher payment look like, and what are you saving, in your pocket, right? Versus how much you're going to end up paying for that higher rate per month. And it was like $3,000 to $4,000. And we ended up going with like almost a full % higher rate for that money, because that meant more to them in that situation than anything else. But they had no idea. There was no option given. It was like, you have to go for this rate because of X, Y, and Z. Here's your option. But it's not an option if it's just one thing, right? It's just, here's what we're forcing you to do. So it's important to know what your options are and have these options to make these decisions. When you're talking about paying the upfront cost of points to lower your rate, what I've been saying to people is, instead of paying the points up front, why don't you take that, let's say $5,000, and put it into an account, right? And subsidize your payment by that, whatever that savings is, $100. So take that $5,000 and offset your payment by that $100. Now, if it's 8, 9, 10 months down the road and it's time to refinance, now you're not thinking, oh, but I invested $5,000, so I'm not going to break even yet for another 3 years. Like, no, you still have that money, and you're still making the payment that you're comfortable with, but you still have that cash. So just different ways to have this perspective. It's really important to have a conversation with one of these guys that can break it down for you in Barney style.
And add one thing. Sorry, Randy. Just add one thing. And if you're working with a loan officer that guarantees you that you can refinance later, even though we think rates will be lower, if anybody guarantees you that you can refinance later, definitely consider finding an alternative loan officer to compare, because none of us can guarantee that.
My favorite with that is not just the guarantee, but the people say, we'll give you a free refinance. It's like, okay, if a good loan officer does 50, 80, 200 loans in a year, and they're primarily purchases in the current market, if next year rates drop 1% and everyone wants to come back, do you think that person's going to do 200 loans for free? No profit. I'm going to work for 2-3 months to clear 24 hours a day to clear it. It defies logic. Basically, all they're doing is saying, we're going to do a no cost loan, and I'm going to tell you it's a free loan, so that don't worry about rates being higher right now. And it just goes to question the mentality that goes into it. I mean, it can definitely be done. You can get a loan that does not cost you any money. That does not mean that it's free. Wrapping up page 2 here, Randy, why don't you walk us through that cash to close? And it's a little bit interesting there in terms of a financed amount with the VA funding fee, where most people are choosing not to pay that out of pocket.
Right. So basically, this is just the point where all these different letters come together to show how it breaks down, and so calculating the cash to close is exactly that. They take the number, even though we don't any of us like the description, the total closing costs. They take that number, which is the real number in this case. They're going to take the closing costs finance paid from your loan amount out of that, because most people don't have 11,400 sitting around that they want to throw at a funding fee, so they finance it, and the VA allows for that on almost every loan. The VA loan doesn't require down payment, so there's nothing there. In this case, it doesn't look like there was a deposit, earnest money deposit, or I think it's different states call it different things. We call it earnest money deposit here. What do you guys call?
EMD.
EMD, earnest money deposit. And then the funds for borrower. There's different instances where there's some different programs that would populate that field. Seller credits, again, there's something that would be negotiated up front would be seller credits, and we see that a lot. At least I'm seeing a lot on my contracts right now, because the days on market is longer, and folks on the selling side are more willing to negotiate, etc. So seller credits, in my case, I see a bunch. Like the one that we closed today had $10,000 in seller credits. They had $8,000 in actual cost, so they ended up having to find a way to spend extra $2,000, which the VA loan allows you to do. So they put that extra $2,000 towards paying off a partial debt that they had. But that's where the seller credits come in right there to make that. And then adjustments and other credits could be a couple of different things that might have to do with what Brandon was talking about, et cetera, where that you're moving things around a little bit. And then you just do the math on add all those up, positive and negatives, and that's what you're estimating cash to close is going to be, the 9261. And obviously that can change depending on if you decide to change on a different day, or maybe, again, this is an estimate that you're starting with up top. Maybe it turns out that it was done off of a template, and instead of actual cost from title companies. So it can change there, but this is the estimated cash, the net of everything. This is where we find it.
Perfect. We like to keep these as an hour. There is a page 3 here. So if you guys don't mind, I will rapidly buzz through page 3, which is about what most borrowers do, is just rapidly buzz through it. So for the most part, what it's going to do at the top of page 3, it's going to tell you whether you're working with a direct lender or a mortgage broker. It's going to have the company and MLS number, where you can go and look up the company and see if they've had any complaints, see where they're licensed, all that fun stuff. And same thing with the loan officer. It's going to give you contact information for your loan officer, which at this point you obviously should have. So comparisons here, this was a new one with the loan estimate. Over 5 years, the total you'll have paid in principal, interest, mortgage insurance, and loan costs totals that up and shows you the principal that you will have paid off. I don't know how super useful it is. Maybe if you're looking at one interest rate versus another, you'll get a different handle on that. The APR we talked about earlier, it's a synthetic number. It's basically, what it does is it takes the amount you're borrowing and then it reduces that by the amount of prepaid finance charges. So most, but not all, closing costs are considered a prepaid finance charge. So if you have a $200,000 loan and $4,000 of prepaid finance charges, they would say, what if you only borrowed $196,000 and you had that same payment? What would the interest rate have been? That slightly increased interest rate is the APR. Again, it was meant for comparison purposes, not super useful. And I think all of us agree here, go back to box A. What's my interest rate? What's my total box A charges on a purchase? That's going to give you a very good handle on being able to compare. This one here, the total interest percentage, again, the government took a shot at inventing another number, and I've never had a borrower, other than asking me, what is this total interest percentage? Never had them ask what my total interest percentage is going to be. So the total amount of interest that you'll pay over the loan term is a percentage of your loan amount. So all of the interest, if you made all 30 years of payments, 15 years of payments, never refinanced, never sold the home, what that percentage would be. So I'm not sure how useful that is. You also have other considerations, tells you whether you're going to have an appraisal, tells you whether the loan is going to be assumable. for the purposes of this show, most people are watching here are veterans. If you have a VA loan, it is going to be assumable. Let you know you're going to have homeowners insurance. Let you know if you're a certain number of days late, you're going to have a payment, a late payment penalty. Let you know again here that you're not guaranteed to be able to refinance. To Brandon's point, no one can guarantee that you will have income, that you will have good credit, that you will have equity in your home, that you will have the ability to refinance going forward. And of course, I have something here on my screen. What's the last one? Oh, the servicing. It just lets you know whether the lender making the loan intends to service your loan, meaning collect your monthly payments, or if they're going to sell it, which again, I don't know about you guys, but sometimes I got people that are worried or concerned about this. And it's like, there's nothing you can do to guarantee that it is never going to be sold. So I would never use that as a factor of who I'm going to get my loan from. And if anyone tells you, no, we never sell our loans unless they're a little tiny local bank or credit union, I would again be highly dubious of them making such a guarantee. So we're exactly at 1 hour. We got through all 3 pages of it, then give you a pretty comprehensive overview of what this looks like. So if you're getting a loan estimate, you want to compare, you want to understand what you're looking at. We've got a pretty good handle on that. But before we wrap up, why don't we go around the horn? I would love to hear from you guys. Just last piece of advice for someone getting a loan estimate, looking at comparing and what their thoughts are. So we're going to go bottom up, Brandon. We're going to let you start first with your final pearls of wisdom, words of advice for the loan estimate.
Side note, real quick. I like to call APR API. Absolutely, positively irrelevant. So, because nobody keeps the loan 30 years. Okay. Piece of advice, just one repeat on that, which is consider a higher rate with lender credit. I would ask for one to compare, especially in this environment where we hope that we'll be able to refinance in the future, reduce your upfront cost. There's so many different things that I could find for people to do with their money than put it into the loan. The other part too, it's more of a CD, closing disclosure, advice more than a loan estimate. If you have too much seller credit, if you're getting, because sometimes you may start with a lender that's in this country that tends to overcharge. Maybe you figure that out mid-process and you switch, and they said, hey, get a bunch of seller credit, and then you switch to a lender that's like, whoa, you didn't need that much. You can find ways to use it. Ask the loan officer about using that excess credit to potentially pay off debt within the 4% seller concession limit. Principal reduction. You can get back up to your earnest money and even prorated taxes if your taxes are paid in arrears. There's different things you can use that money for. Loan officers typically aren't skilled to catch it. If they reduce your seller pays at closing, I get upset about it because it's cheating you as the veteran out of the money the seller has guaranteed you and offered you. There's no reason for that to be reduced. And there's a list of ways, and it's discussed inside of VA community too. There's a list of ways to use that money so you don't give money back to the seller, but you may have to catch it yourself, unfortunately, to force the loan officer and the lender and the title company to do something about it. But anyway, that's my last piece of advice.
I like it. Thomas, what do you got for us?
2 things, if I can. A loan estimate that is not locked is not real, right? So there's nothing that forces us to have to disclose points on an estimate that is not locked. But once it's locked and we disclose it, we cannot decide to raise or decrease I guess we could decrease, but we can't raise those points just because we feel like it arbitrarily. So if somebody's showing you an estimate and you're considering like 2 and you are going to go forward with one of them, if it's not locked, it might not be real. So make sure you're committed to the person that you're working with and they're willing to go that far of locking that loan for you so that you know what it is. Number 2.
I just want to say that's not even just a matter of someone lying to you. Oftentimes we'll get this, well, someone got a loan estimate 2 weeks ago and they're thinking in terms of refinancing. They're like, oh, your numbers are high. I'm going to go back to this guy. It's a lot lower. It's like that LE was 2 weeks ago. It probably was a real number, but rates are much higher now. His number is going to be higher. So not just that they're not being honest with you, things change. If it's not locked, it can and will change on you.
Yeah, I mean, yesterday we gained like a quarter in rate yesterday in one day out of like nowhere. So it's really important. Compare this stuff same day, and if it's not locked, it's not real. Number two, I think that the most important thing over all the details that are involved in the loan estimate is make sure that you're comfortable with your loan officer, and that they are able to communicate with you on a level that you fully understand that aligns with your financial goals. Like, make sure you're clear with them on what you want to do. I'm always trying to have a conversation on Zoom with that initial application. I'm trying to avoid sitting at that link because there's so much that you learn about somebody in a phone call or a Zoom call, that helps me as a professional, and any of you guys, I'm sure, kind of navigate around bumps that might come along the way where I don't have to bother you because I already know the answer to this, right? My goal is always to make sure that at the end of the process, you feel like you didn't even go through the process. Like, everyone's complaining about it and you're like, wow, that was so easy, because that's what we're supposed to do. We're supposed to make it easier for you. So make sure you're comfortable with that person and that you understand what they say, and you don't feel like you're being annoying by asking the same question 10 times. That person that you're working with should be very, very understanding of this, because we go through this every day from square one, every single time. And sometimes we have to do it multiple times, and sometimes we don't have to do it at all. Right. But at the end of the day, we should be going at your speed. So make sure you're comfortable with that person that you choose to work with. Realtors too. Same thing.
Randy?
Well, you obviously my biggest thing you guys have covered, and not to beat a dead horse, but whenever you're shopping, shop all in the same afternoon, because just exactly what you guys talked about is that things change, and right now they're very volatile. And had you shopped with someone 3 days ago, and then the rates made the change that Thomas is referring to, it was not apples to apples. You're not getting the same comparison, and therefore you're going to be totally off. And then number two, timing wise, if you're not comfortable with that person that you've been dealing with, the sooner the better that you find someone that you're comfortable with, that communicates well, that's accessible to you when you have questions. And obviously people work different hours, etc. I know that if you're working with someone that works only 9 to 4, and you're working 9 to 4 at the same point in time and don't have time to deal with that, it's important to find someone that's going to be accessible when you are. So comparing lenders is more than just numbers. It's going to be a communication, which is, in my opinion, probably the most important part of it. Being comfortable, being able to ask that question 4 times and feel like you got an answer that made sense to you. It wasn't necessarily loan officer language. That's my big thing.
I will leave you guys with one thought on this. We get a lot of our leads from our podcast, YouTube channel, and it's a lead form, and it always asks a question: what's most important to you about this process? And the most common answer, by like a 10-to-1 margin, is getting the lowest rate and fees. Getting low rate and fees are important, but oftentimes borrowers, as a consumer, that's one of the only things that you know to ask. And you're sort of walking into a trap. There are so many ways to go about this. Mortgages, to a degree, are a commodity, but the delivery of that, a stress-free process with honest, accurate answers throughout the process, with knowledge and expertise, what Thomas was talking about, patience and understanding, sadly, it's uncommon. So the loan, at the end of the day, once it's closed, note rate to note rate, loan amount to loan amount, VA loan is going to be the same. Your experience and your process is going to be very different. So by all means, you want competitive rates and fees, but if your objective is to go out and say, I'm going to get the absolute rock bottom lowest rates and fees, you may save $500 or $1,000. You might save $2,000. But for the most part, what I see is people pay for that over and above what they should have in terms of dealing with an expert. And that's, it's what Christopher Griffiths tried to do here with Vetted VA, is making sure that we are only taking you to professionals who have been vetted, who've been through the process, who are educated, who do meet all of those criteria. So when you're shopping, shop for more than just a competitive rate. Make sure you're shopping for a pro that understands you, that you connect with. So with that, we're going to wish you all a happy Thanksgiving here in 2 days. We'll be back next Tuesday with another set of pros. I appreciate you gentlemen being here with me tonight and sharing your knowledge. And again, happy Thanksgiving to you guys.
Happy Thanksgiving.
All right. See you, gentlemen.
See you guys.